So you're invested. That's great news. Now stop for a moment and digest what you have just done. Here are 5 things that you must stop doing while you have your money invested. Number 1. Impulsive decision making. Avoid making investment decisions based on emotions or short-term market fluctuations. Impulsive buying or selling can lead to poor investment choices and financial losses. Instead, focus on a well-thought-out investment strategy and stick to your long-term goals. Here are some examples that you may find relatable. Emotional responses. Investors may react impulsively to short-term market fluctuations driven by fear or greed. For example, selling investments during a market downturn out of panic or buying into a hot trend without proper research. Chasing performance. Following the crowd or investing in a particular asset simply because it has recently performed well can be impulsive. This behavior might lead to buying at the peak and suffering losses when the market corrects. Lack of planning. Failing to have a well-thought-out investment plan and deviating from it based on short-term market movements can be detrimental. Investors may make impulsive decisions without considering the broader financial goals and time horizon. Overreacting to news. Reacting hastily to breaking news or sensational headlines without verifying information can lead to impulsive decisions. Markets can be volatile, and knee-jerk reactions may not align with a rational long-term investment strategy. Ignoring risk tolerance. Making impulsive decisions without considering your risk tolerance can result in investments that are too aggressive or too conservative for your comfort level. This may lead to unnecessary stress and potential financial losses. To avoid impulsive decision-making, it's important for investors to maintain a disciplined approach, stick to their investment plan, and base decisions on careful analysis rather than short-term emotions. Patience and a focus on long-term goals can help mitigate the negative impact of impulsive actions on investment outcomes. Number 2. Ignoring diversification. Concentrating your investments in a single asset class, industry, or region can expose you to higher risks. Diversification helps spread risk across different investments, reducing the impact of poor performance in one area on your overall portfolio. Don't put all your eggs in one basket. Diversify your investments for a more balanced and resilient portfolio. The primary objective of diversification is to reduce the impact of poor performance in any one investment on the overall portfolio. By spreading investments across different asset classes, industries, and securities, you minimize the risk of a significant loss in case a particular investment underperforms or adversity. Moreover, concentrating your investments in a single stock, industry, or asset class exposes you to concentration risk. If that specific investment faces challenges or performs poorly, it can have a disproportionate impact on your overall wealth. Diversification helps guard against concentration risk by ensuring that your portfolio is not overly dependent on the success of a single investment. Not to mention the fact that different investments respond differently to various market conditions and economic cycles. Diversification allows you to capture opportunities and navigate challenges in different market environments. Diversification allows investors to optimize the risk-return profile of their portfolios. By combining assets with varying levels of risks, investors can achieve a balance that aligns with their risk tolerance and financial goals. This optimization is critical for building a portfolio that seeks to maximize returns while managing risk. Diversification is particularly important for long-term investors. Over an extended period, markets can experience various economic cycles and fluctuations. A well-diversified portfolio is better positioned to withstand the ups and downs of the market, providing investors with the potential for more stable and sustainable returns over the long term. Diversification extends beyond stocks and includes other asset classes such as bonds, real estate, and commodities. Each asset class has its own risk-return profile, and combining them in a portfolio can provide a more stable overall return. In summary, diversification is a fundamental principle in investing that every investor should know about and incorporate in their long-term investments. It's a strategy that helps investors navigate uncertainties in the financial markets and work towards achieving more stable and consistent returns over time. Number 3. Neglecting research. Failing to conduct thorough research before making investment decisions is a common mistake. Whether you're investing in individual stocks, mutual funds, or other assets, take the time to understand the fundamentals, market trends, and potential risks associated with each investment. Informed decisions are more likely to lead to successful outcomes. Research is essential for making well-informed investment decisions. Neglecting research means you may lack the necessary information to assess the fundamentals of an investment, understand market trends, and evaluate potential risks. Informed decisions are more likely to align with your financial goals and contribute to successful outcomes. Research helps you identify and assess the risks associated with different investments. Imagine you're playing a game where you can win or lose points. Before you make a move, it's like doing your homework about the game. You want to know the rules and understand how things work. If you don't do your homework, you might make a move that could cause you to lose points. In the same way, when you're investing, you're putting money into different things that can go up or down in value. Doing research is like doing your homework before making decisions about where to put your money. If you don't do your homework, you might miss important information, and that could make you lose money. Managing this risk or being careful about the choices you make is a really important part of being successful when you're investing. So, just like you wouldn't play a game without understanding the rules, it's important not to invest your money without doing some research first. Financial markets offer a wide range of investment products, from individual stocks and bonds to mutual funds and exchange-traded funds, ETFs. Each product has its own characteristics, risk profile, and potential returns. Researching these products allows you to choose investments that align with your investment strategy and risk tolerance. Moreover, researching market dynamics involves staying informed about economic indicators, industry trends, and geopolitical events that can influence the performance of your investments. Imagine a stock market as a giant, ever-changing game where companies are the players. Now, these companies' performance is influenced by a bunch of things happening in the world. Just like how a player's moves in a game are influenced by the rules, what's happening around them and what other players are doing. Think of economic indicators as scoreboards in the game. They show how well the overall economy is doing. Things like employment rate, inflation, and GDP growth are like points on the scoreboard. When these indicators go up, it's generally good for companies and their stock, shares of ownership in a company. Prices might go up. If the indicators go down, it could be a tougher game for companies. Industries are like different teams in the game. Some industries like tech or healthcare might be doing really well because of trends and advancements. However, like traditional manufacturing, might be facing challenges. Investing in industries that are on the rise could be like picking winning teams in the game. This is the outside noise affecting the game. Geopolitical events are like unexpected power-ups or challenges. For example, a sudden change in government policy or an international conflict can impact how companies perform. If you're not paying attention to these events, you might miss important cues in the game, affecting your investment choices. Regularly assessing the performance of your investments requires ongoing research. By neglecting this aspect, you might miss opportunities to optimize your portfolio, reallocate assets, or identify underperforming investments that may need adjustment. Continuous research is vital for adapting your investment strategy to changing market conditions. Research is crucial for due diligence, especially when considering new investment opportunities. Neglecting research might make you more susceptible to falling for investment scams or fraudulent schemes. Conducting thorough research helps you identify legitimate investment opportunities and avoid potential financial pitfalls. It goes without saying, neglecting research can hinder your ability to build and maintain a robust investment portfolio that stands the test of time. Regularly updating your knowledge through research enables you to adapt to evolving market conditions and make well-informed decisions for long-term success. Number 4, timing the market. Trying to predict short-term market movements or waiting for the perfect entry or exit point can be challenging and often leads to missed opportunities. Market timing is notoriously difficult, even for experienced investors. Instead, focus on a long-term investment strategy and consider a systematic approach like dollar cost averaging, where you invest a fixed amount at regular intervals. This involves trying to buy assets at their lowest prices and market bottoms and sell them at their highest prices and market tops. However, timing the market is challenging and often associated with several risks and drawbacks. As mentioned before, financial markets are influenced by numerous unpredictable factors, including economic indicators, geopolitical events, and investment sentiment. Predicting how these factors can play out and affect market movements is inherently uncertain. Frequent buying and selling of assets to time the market can lead to higher transaction costs, including brokerage fees and taxes. These costs can erode your overall investment returns. Let's not forget that constantly monitoring market movements and making decisions based on short-term predictions can lead to emotional stress. Investors may be prone to making impulsive decisions driven by fear or greed, which can negatively impact their long-term financial goals. Investing is generally viewed as a long-term endeavor where the focus is on the fundamental value of assets and their potential for growth over time. Market timing, on the other hand, often involves short-term speculation and may not align with a disciplined strategic investment approach. Instead of attempting to time the market, many financial experts go for a more disciplined and systematic approach to investing. These include dollar cost averaging, investing a fixed amount of money at regular intervals regardless of market conditions. This approach can help mitigate the impact of market volatility. Asset allocation, diversifying your investments across different asset classes based on your risk tolerance and investment goals. Long-term perspective, focusing on long-term investment objectives rather than trying to profit from short-term market movements. Number 5, overlooking fees and costs. Ignore the impact of fees and expenses on your investment returns can erode your profits over time. Be aware of transaction costs, management fees, and other charges associated with your investments. Choose low-cost investment options whenever possible and regularly review your portfolio to ensure that the fees are justified by the performance and services provided. Remember that investing involves risks, and there is no guarantees of profit. It's essential to approach investments with a well-defined strategy, realistic expectations, and a focus on long-term financial goals. It emphasizes the importance of paying attention to the various fees and costs associated with investment products and transactions. Fees and costs directly impact your investment returns. Higher fees can erode a significant portion of your gains over time. By minimizing these costs, you retain a larger portion of your returns, helping your portfolio grow more effectively. Over the long term, even seemingly small differences in fees can have a substantial impact on the total value of your investment portfolio. Lowering your costs allows you to harness the power of compounding, potentially resulting in a larger nest egg for your financial goals. Of course, understanding the fees associated with different investment options enables you to make informed comparisons. Comparing expense ratios, transaction costs, and other fees allows you to choose investments that align with your financial objectives and cost preferences. Moreover, investors often assess risk-adjusted returns, which consider both the returns and the level of risk taken to achieve those returns. High fees can affect the risk-adjusted performance of your portfolio, potentially making it less attractive compared to lower-cost alternatives. When working with financial advisors, it's important to understand their fee structure. Fee-only advisors charge clients only for their advice, while fee-based advisors may earn commissions from financial products they recommend. Understanding these arrangements helps you choose an advisor whose compensation aligns with your preferences. Specifically, buying and selling investments often incur transaction costs, such as brokerage fees and commissions. Overlooking these costs can impact your overall investment returns. It's important to be aware of the expenses associated with each trade and consider more cost-effective trading strategies, especially for frequent traders. Not to mention that many investment funds, such as mutual funds and ETFs, charge management fees to cover the cost of overseeing the fund. Moreover, expense ratios represent the total annual cost of operating a mutual fund or ETF expressed as a percentage of average assets. Lower expense ratios generally translate to lower costs for investors. Overlooking expense ratios can result in investing in funds with higher ongoing costs, impacting your long-term returns. Some mutual funds charge load fees, which are sales commissions that investors pay either when buying front-end load or selling back-end load shares of the fund. No-load funds, which do not charge these fees, may be more cost-effective options. If you use the services of a financial advisor, be aware of the fees associated with their advice. Advisors may charge a percentage of your assets under management or a flat fee. Understanding these costs is essential for evaluating the value of the services provided. For international investments, currency exchange costs can impact returns. Pay attention to transaction costs associated with converting currencies, especially in global investment portfolios.